Mark, talk to us about the divergence we've seen. It's pretty pronounced, isn't it, when it comes to the tech stories of both the US and China? Is this likely to be sustained?
It's absolutely phenomenal, the divergence we're seeing. And you're right, Tom, to emphasise that the extraordinary rally that we've seen this year in Hong Kong stocks primarily, but also in China, is very much tech-driven. It's not about the real economy in China. I think that's really important here. I don't think this is necessarily a passing of the baton. It's not a change of the guard. What it is that US tech stocks were exorbitantly expensive and just irrationally so on a sustained basis. Meanwhile, China tech stocks were just way too cheap, way too discounted. And what we're doing is we're correcting some of that misalignment. So Chinese tech stocks are starting to become more fairly valued, and we're removing some of the premium that was seen to US tech stocks. I think both these moves are rational. I think that we're getting to a more realistic place. I won't say the continued divergence of performance will extend, but it's not going to reverse from here. People have realized that China and Hong Kong stocks can gain from the AI tech boom, and US tech stocks aren't the only show in town.
Mark, Kriti talked about the recession fears. You warned us about them yesterday. Surely they haven't gone away despite the Trump administration dangling these tax cuts. I wonder how low the 10-year yield could actually fall.
I think the 10-year yield will go a chunk lower in the coming weeks. This is just a temporary bump higher, given an extraordinarily large move lower, particularly yesterday, but also over the last couple of weeks. The narrative is changing. The growth concerns in the US are going to remain for some time at least. In the very short term, will probably be dominated by Nvidia earnings today, and that may mean, any ask can go anywhere in the next 24 hours, 48 hours or so. But overall, 10-year yields are going to go lower in the coming weeks because growth concerns in the US are coming back into the fore. Now, whether this means we're actually going to get a recession is a completely different issue. What it means is that we're going to disappoint elevated US growth expectations. The rest of the world is doing better than feared. US is probably not going to deliver as much growth as has been hoped for as recently as the last few weeks.
But Mark, isn't the antithesis to that argument simply that if you do get a tariff uptake across the world, that's ultimately inflationary and pushing those yields in the opposite direction?
I think it is ultimately inflationary. To what degree will wait to be seen. But I think it's dominated for now by the growth concerns. We know that tariffs are negative for growth. We know that they're negative for US growth. And the uncertainty in flip-flopping is particularly damaging for US companies. So all the cost for this, the moment in the short term, is on the US economy, and that's going to feel the pain. Now, it might ultimately be inflationary as well, but it's not going to be significantly inflationary if the economy is getting really hurt. So, yeah, people will feel it like a little bit of a stagflationary impulse, but it's the stagnationary side, it's the growth side that'll dominate more in the short term. So in the short term, at least, US 10-year yields have further to fall. I actually think they'll be higher again later on in the year, but that's a story for another day.